Hello, Matthew Copley here with Copley Financial Group, and today we're going to do a market update. We're going to talk about all the changes that have taken place in the markets since the last time I did a market update. We're going to touch on the VIX index, the volatility, the recent big drop in the stock markets, and what we see going forward. We're also going to talk about Trump's economic plan, do a quick assessment on that. We're going to talk about the buffered index, the multi-year guarantee annuities, what the current rates are, what we're looking at, and what we might look at going forward. One thing I do want to mention is I want to make sure everyone saw the update we did on the new integration software with GeoWealth. If you haven't seen that email, you haven't seen that video, please email us back. You can reply to the email that this video is on, and we can resend that out to you. But we want to get all those DocuSigns completed so everyone's on the new integrated software, and we're very excited about it. It's going to allow us to be a lot more efficient, and it's going to allow you to see all of your accounts in one spot with actual aggregation. You're going to see your performance reports, your returns, everything blended together. It's going to work out great. So the first thing that we're going to cover today is what's going on in the stock market, and it's been a wild one. The volatility gauge has spiked to all-time highs. We've seen, obviously, if you've been watching the news, the stock market has crashed and then rebounded and then crashed. So we've seen some massive volatility in the markets, and I want to explain to you what's going on and what we see going forward. So the main reason that we saw this big drop in the markets and that there's a lot of concern out there is the jobs data. We got a really weak jobs report for July, and I really want to dive into that so you understand why it is considered such a weak report. On the surface, it doesn't look that weak, but when you start diving into the numbers, you start to realize it is a pretty weak jobs report. Now, this triggered a huge spike in the volatility gauge, what we call the VIX index. It actually hit 65 last week, which is just a crazy number. If you would have told me ahead of time that the VIX was going to hit 65, I would have expected the stock market to be down 10 or 15 or 20%, massive drop. We really haven't seen that, which tells me the stock market is a lot more resilient than I thought. We may not see as big of a drop as I thought we would. Obviously, as you know, we sold a lot of the positions we had in stocks to hedge, so that was a really good move with the current volatility in the market and the big drops. It helped protect our client accounts, which have done great during this whole big volatility. But the main thing is that jobs report, and underlying it, I want you to understand what's inside of it. The jobs report has a different numbers that they provide. The main number that everyone uses is called the U3 number. This is the amount of unemployment that we have. And I want everyone to understand that that U3 number has changed. In fact, in the 1990s, the U3 number actually was adopted, the new one that we have now, which has a lot of adjustments that the government has made on those numbers. And those adjustments make the unemployment rate look lower than maybe it would be under previous ways that they calculated unemployment. So they still do the old unemployment. That's now called U6. And so we can still see the unemployment numbers on U6 without all of the adjustments and things that they do. And that number has actually spiked up to 7.8%. This is a really high unemployment number. And this is where a lot of the concern comes in. Of course, with a high unemployment, there's a higher likelihood for the government, the Federal Reserve, to lower interest rates, which is positive for the market. But this is a situation where the number was so bad that it looks like we may be going into a recession. And obviously, unemployment is a lagging indicator, which means this is what happened in July, and here we are in August, so the momentum is not good. So that is the initial reason. Now, a lot of the media and what you've been seeing is all about the Japanese yen carry trade, and this is what caused the big spike in the market, and that was a big part of it. I think the recession probability was probably the number one reason. The second reason is what's going on in Japan. And it's really interesting what's been happening over the years. This is what's called the yen carry trade. And this is when banks and other institutions, they borrow money in Japan. And this has been going on for years. They borrow money in Japan at these low interest rates because the Japanese government has been artificially keeping interest rates low in Japan. And so they borrow money in yen and they turn around and they buy assets in other currencies and things outside of Japan. And the way it works is very simple. If you can borrow money at 2% and then you can take that money and invest it and make 5%, you get to make the 3% spread. So this is like free money. This is great. Everyone's doing this. All the big institutions, the big banks, especially the banks in Japan, have been doing this. And unfortunately, what's happened is the Japanese government has finally decided to start raising interest rates. And they just raised 0.25%, so you wouldn't think that's a whole lot, but when you start at a level close to zero, raising 0.25 is a big deal. It's a huge jump. And so we saw essentially the markets really capitulate with this whole increase. And what happened with this yen carry trade, so everyone understands what's going on, is in the event that the yen, the actual currency, increases in value relative to the dollar, you potentially are losing money, because if you have assets outside the yen and the yen is increasing in value versus other currencies, now all of a sudden you're losing money on those assets just on the currency trade. But even worse, if the assets that you bought are going down in value, this can create what's called a margin call, which means the banks may force you to liquidate those assets in order to pay back your loan. And if you're liquidating those assets and they're down in value, you're getting less money, and then you're also getting less money on the currency. This is a big deal. Now, according to a lot of the experts on Wall Street, they think that this entire carry trade has been unwound by about 50%. So about 50% of this is still outstanding, still being unwound, but a good half of it's already done. So I don't expect a whole lot more volatility due to this yen carry trade. It's possible we get some more. What I am interested in is finding out who lost a lot of money. So that will come out at some point. We don't know yet, but someone lost a lot of money. It was probably the Japanese banks and other institutions, but this was a huge unwind, potentially margin calls on various companies that lost a lot of money. We don't know quite yet what exactly happened. Finally, the last thing that caused this big drop in the markets is the unwind of the big tech stocks. These have really outperformed companies like Nvidia, Google, Amazon, that have kind of led the market up. Those stocks are starting to get sold. The valuations have just gotten ridiculous. I've talked about this multiple times in previous videos. The PE ratios that we're seeing in those are just out of sight, and so people are finally starting to wake up and realize that those are overpriced, so they're selling those positions. We're seeing a lot of those tech companies drop. This has not really impacted any of our clients because we're not invested in all those overvalued companies, but that has impacted the indexes in the market. Obviously, those companies led a lot of the market up, and now they're leading the indexes down, and so again, it will not affect us much as far as the big tech unwind, but I think this will continue. I think we're just getting started on the big tech companies dropping in value. We're seeing really high valuations in these still, even after this drop. It's not even close to being done yet. And when you look at long-term ratios for PE, for example, the CAPE ratio, the CAPE ratio, which is the Shiller index, if you go back and look, we're trading at the highest CAPE ratio we ever had. In fact, there's never been a time in history when the CAPE ratio has been this high and we actually had a positive return in the stock market over the next 10 years. And so this is a real concern. This is one of the reasons that we are being very cautious, very conservative. You're seeing a lot of the accounts that we have in more guaranteed things, in fixed income, in guaranteed annuities, in buffered indexes, things that we have hedged against the market, because the probability, it's not guaranteed, but the probability of having really high returns in the stock market are a lot less now than they were in the past, especially in these big tech companies that are just simply overvalued, and they're still going to be coming down going forward. Potentially over the next year, 2 years, you're going to see this big shift from the growth companies to the value companies, and we're positioned very well for that. The next thing I want to cover is the Trump economic plan. We do not have the Harris economic plan yet. She did announce at a recent speech that she is going to come out with her economic plan here shortly. That was just a couple days ago, so I expect to see that and I will definitely give an analysis of her economic plan in a future market update. But we have Trump's plan on what he wants to do going forward. So I'm going to do some quick analysis of that so you can get an idea. And obviously with the assassination attempt, I think that the odds of Trump getting reelected or getting elected again are a lot higher now than they were before that. So let's talk about what would happen if Trump was elected and he was able to implement his economic plan. Well, one of the things he wants to do first is to extend the Trump tax cuts that he put in place in 2017. Now, those tax cuts were only good for 10 years. And so even if nothing happens, we go back to the tax rates that we had under the Obama administration. And so, for example, the current 12% tax bracket would go to 15%. The current 22 bracket would go to 25%. And so what Trump wants to do is extend those tax cuts to keep those rates on those brackets at the lower levels. And of course, extending tax cuts obviously means that there's less money coming in for the government. So we have to figure out how to pay for that. Now, the other thing he wants to do is he wants to eliminate taxes on certain things. One of the things he wants to eliminate taxes on is Social Security. Now, I am absolutely in favor of this. I think it's a ripoff that retirees have to pay taxes going into Social Security, and now they have to pay tax on Social Security coming out. We already have tax-free income on Social Security here in California and a lot of the states. In fact, 38 states do not tax Social Security at all. But the federal government potentially does based on your other income. So if we were to just eliminate income tax on Social Security, I think it would be a real positive thing. It would cause about an $80 billion deficit, because that's about the amount of money that the government is collecting from taxes on Social Security. So we have to make up for that somehow. And so I think it's a positive thing to eliminate taxes on Social Security income, but we got to figure out how to pay for it. The other thing he wants to eliminate taxes on is tips. And this is a big part of the economy. A lot of people operate on tips. Now, I agree with this as well. I think that tipping or paying tax on tips is not right. In fact, if you pay someone an income, as a business, you're able to deduct that. That's a cost to doing business. So when you pay someone on their payroll, that's a deduction. So that makes sense. The company gets to deduct it, and the person collecting the income, they have to pay tax on it. But with a tip, the person giving a tip doesn't get to deduct that off of their taxes. If they give someone a tip, they don't go and get to deduct it. So it's not really fair that when we're giving someone a tip that the person has to pay tax on that money, because there is no deduction on the person giving it. And it is important because when we look at this, this is really a gift. This is not income. It's someone giving someone a gift. No different than anyone giving a gift. You can gift $18,000 to someone and pay no tax. And so this is really a gift, whether it's $2 to the valet person or it's a gift to a larger amount. This should not be taxed. Now, of course, is a big part of the economy is tips. Now, a lot of those people, if they can get away with it, are probably not paying tax on those tips anyway, but a lot of it is paid through like restaurant waitresses and bartenders and things, and they do have to pay taxes on those because they can see how much in tips is coming in. And so this is another thing you got to figure out how to pay for. If you eliminate the taxes on all the tips, I think it's positive for the economy, but you got to figure out how to pay for it. So how Trump is planning on paying for the extended tax cuts and tax-free Social Security and tax-free tips is with tariffs. Now, what is a tariff? A tariff is simply a tax that we all have to pay on goods that are made outside the United States. Now, the United States used to have a lot of tariffs. In fact, our whole government operated off of tariffs for a long time. And over time, a lot of those tariffs have been cut, reduced. And the tariff is a real bad idea in a lot of situations. So what Trump's talking about as far as tariffs, one of the things that I'm happy to hear is he's talking about a across-the-board tariff. One of the problems with tariffs, and we ran into this in many times in history, which has led to recessions and depressions, is when you start doing targeted tariffs, what you get is retaliation. Other countries then raise the tariffs on American-made products, and all of a sudden it's this tit-for-tat thing that ultimately leads to a downturn in economics. It's not a good thing. But if you were to do a tariff across the board where it doesn't matter what country, it doesn't matter what good, you just play a flat tariff, say 10 or 15%, that would make a lot of sense. This would actually promote goods and services here in the United States. It would encourage people to buy US made goods and not buy the stuff. Now, of course, this is a problem for the stock market because a lot of companies make things in China and Mexico and other places around the world, and they actually, we import all those things here to the United States. And those things would cost more. And so this would obviously encourage companies to make stuff here in the United States and not in other countries. And this takes time. This is not something you can just turn a switch and all of a sudden we start charging these tariffs and then all of a sudden all these jobs come back to America. It takes time. And one of the other big problems with this tariff idea is all the red tape for starting new businesses. Now, if you increase tariffs and you encourage new workers and new jobs here in the United States, you got to have companies that are willing to go out and hire people and start new jobs. And so we would need here in the United States a reduction in the red tape for new businesses, for companies that want to expand, for companies that need new licenses and permits and things like that. So hopefully, if we can reduce some of the red tape at the same time tariffs come in, I actually think it could be a positive thing as long as, again, it's across the board tariff. It's not something where it's kind of, they're talking about big tariffs on China and small tariffs. And that's where you get into a lot of trouble. It creates a lot of animosity around the world, and it can lead to trade wars, which is not a good thing. So free trade is a good thing. But again, across the board tariff, I am in favor of. At the end of the day, we all would pay more for things that are made outside the United States versus inside. And so that is a hidden tax. You don't have to pay it if you're not buying those things from outside the United States. You stick to the stuff here. But obviously stuff made in the United States today typically costs more money than the stuff that's made outside the United States. All right, well, let's talk about some of the products that are available today. Obviously, we're really happy with all the positioning we have for our clients. We're heavy in value stocks and all the things that we think will do well going forward and have actually helped us kind of protect us in the current market environment and the volatility. So let's talk about some of the insured accounts that we have. So the buffered index portfolio is something that's done very, very well for us. We continue to like that. The one that we have available now, August the 22nd, is our deadline to be able to get money into that. And it's very simple. It's a 20% cap with a 20% insurance buffer, just like all the other ones that we've done in the past. It goes up with the S&P 500 over a 2-year time frame. If the market goes up anywhere from 0 to 20%, you get the whole thing. If the market goes up 10, you get 10. If it goes up 15, you get 15. If it goes up 20, you get 20. But it does cap at 20%. So if the stock market is up 25 or 30%, you're only going to get 20%. And so you are agreeing to give up everything above 20. Well, in exchange, we're able to buy an insurance policy that pays the inverse return on the way down, all the way down to 20%. This means if the stock market's down 10, not only do you not lose money, you make 10%. If the market's down 15, not only do you not lose money, you make 15%. All the way down to 20. If the stock market goes down more than 20% over those 2 years, you just get a 20% reimbursement. So if the market, say, was down 25%, you'd get reimbursed for 20 of the loss, you'd still be down 5%. These are a great way to invest in the markets to have that protection. And if the market is down, say, 10%, you actually make money. So I like those buffered indexes. I think they make a lot of sense. The current pricing is good with a 20 cap. With the VIX index spiking up like it has, there's a good chance that we're not going to have as good of a cap next month. We're not going to have as good of terms. So you do want to get into these sooner rather than later before some of these terms start to drop. And so we're going to be looking at this with our existing clients. I'm happy that we stayed in stable value with a lot of our clients because we didn't participate in the big volatility and the drops in the stock market. But we definitely want to get back into these buffered indexes sooner rather than later in order to take advantage of the current cap rates. Now, as far as guaranteed insured accounts, the MYGAs, still highly recommend these. Guaranteed interest, cannot lose. This is where you put money in. It's like a CD with the bank, but it's with an insurance company called a MYGA, or multi-year guarantee annuity. We currently have a 3-year, and I believe the interest rates are the same as they were the last video that we did. The 3-year is paying at 5.8 5.32%, 5.32 guaranteed every year for 3 years. There's no fees or anything on that. What you see is what you get. The 5 year is paying 5.02, so a little bit less on the 5 year. Again, one of the reasons is we have an inverted yield curve. You get more interest on the shorter durations than you do the longer because people are worried that interest rates are coming down. According to the predictive models online, you're seeing that there's like 100% probability the Fed's going to lower rates by at least a quarter point in September. So it's a good idea to lock in these rates. If interest rates do get lowered, you're going to see these rates more likely than not go down. So it's a good idea to lock them in for as long as possible. And so we have those available, and you're welcome to come in. One last thing I want to reiterate, the GeoWealth that we did. We sent out an email. If you haven't got that, please reach out to us. You can reply to the email this video is on. You can email support@copleyfg.com. We want to get those DocuSigns completed, get you all set up with the integrated software. We're really excited about it. I think you'll be excited having one login, being able to see everything in one spot, all your accounts integrated. So look out for that. Make sure you complete those DocuSigns. And again, if you are a couple, the first person on the account, oftentimes it's the husband, the first person on the account has to sign the DocuSign before it goes to the second person on the account. So the second person can't sign until the first person does. So make sure you look out for those. We want to get all of those completed so we get that integration done. And thank you all for watching. I hope to see you in our Mission Valley office very soon.